It's easy to spot a for sale sign around Charlottetown, and with the Bank of Canada dropping the interest rate, it signals a good time for new buyers.
It just shows a little bit more confidence in our marketplace, and it generally, as markets or the interest rates go down, then we'll see first-time buyers specifically be more prepared to enter the market.
On January 28, 2026, the Bank of Canada made a decision that over 1.2 million Canadian mortgage holders were dreading. They held the rate. Again. No cut, no relief, just a hold at 2.25%, and a signal that felt like a door slamming shut. And here's what makes it worse. That decision landed right at the peak of what analysts are calling the biggest mortgage renewal wave in Canadian history. Over 60% of all outstanding mortgages in this country are up for renewal in 2025 or 2026. Most of those were locked in during 2020 and 2021, when rates were sitting at historic lows near 2%. Now, those same homeowners are walking into renewal conversations and being handed rates around 3.8% to 4.5%. For a $500,000 mortgage, that's potentially $800 more per month. So let's break down what just happened, why the bank made this call, and what it actually means for your wallet right now.
To understand why this is such a big deal, you have to understand what homeowners were expecting. After one of the most aggressive rate hiking cycles Canada had ever seen, the bank pushed its overnight rate all the way up to 5% in mid-2024. People watched it slowly come back down through 2025, 4 cuts across the year. By October 2025, the rate had dropped a full percentage point down to 2.25%. People were relieved. They thought more cuts were coming. They planned around more cuts coming. But then, in December 2025, the bank paused. Then, January 2026, another pause. Governor Tiff Macklem said the current rate is, quote, at about the right level. And most market economists are now saying that's likely where it stays for the rest of 2026. RBC Economics, TD Economics, and the National Bank of Canada all project the overnight rate holds at 2.25% through the end of the year. Scotiabank is actually going the other direction. They think rates could rise by 50 basis points in the second half of 2026. That's not a typo. Some of Canada's biggest banks think rates could go up, not down. So why is the bank holding? 2 main reasons. First, inflation hasn't fully cooperated. As of January 2026, headline CPI is sitting at 2.3%, which sounds close to the 2% target, but core inflation measures are still hovering around 2.5%. That's sticky enough that the bank doesn't feel the urgency to cut. Second, tariff pressure from the U.S. is creating real uncertainty. Higher tariffs on Canadian goods push up the cost of materials, which feeds into inflation. The bank can't cut aggressively when it's watching trade tensions add pressure to prices. The result? Mortgage holders are stuck. Here's where it gets heavy. According to the Bank of Canada's own analysis, roughly 60% of all outstanding Canadian mortgages are renewing in 2025 and 2026. That's not a small group. We're talking about 1.8 million homeowners hitting the renewal table in the next 12 months alone. And the math is brutal for a lot of them. A homeowner who locked in a 5-year fixed mortgage in 2020 or 2021 was probably paying somewhere around 1.75% to 2.5%. Today, the lowest 5-year fixed rates available are sitting around 3.69% to 3.84%. That's nearly double what they were paying. According to Bank of Canada modeling, 5-year fixed borrowers renewing in 2026 are looking at payment increases averaging 15 to 20%. RateHub.ca ran the numbers on an average priced home purchased in 2020. That borrower could see their monthly payment jump by about $424 this year alone. That's $5,100 more per year for the same house. A Royal LePage survey found that 57% of Canadians renewing this year expect their payment to increase, and of those people, 81% said it would put real financial strain on their household. The pressure is showing up in the data, too. Equifax Canada reported that missed mortgage payments rose 23.1% year over year as of Q1 2025. In Toronto specifically, mortgage arrears have more than quadrupled since 2022. CMHC data projects Toronto's arrears rate could hit 0.34% by the end of 2026, the highest level since 2014.
In Ontario, the mortgage delinquency rate jumped over 90% year over year. But that's just one part of the story. If this kind of breakdown is useful to you, hit subscribe right now. We track the housing market, interest rates every single day. You don't want to miss the next update because this market is moving fast and the next decision from the Bank of Canada is already scheduled for March 18th.
Here's something a lot of people don't realize about how this works. When the Bank of Canada cuts its overnight rate, it directly impacts variable rate mortgages. Those borrowers felt some relief in 2025. They watched their payments come down as the rate dropped. But fixed-rate mortgages work differently. They're tied to Government of Canada bond yields, not the overnight rate. And right now, 5-year bond yields are sitting around 2.7% to 2.8%. After spiking hard in December 2025, they've come down a bit, but lenders aren't passing much of that on. 5-year fixed mortgage rates are holding around 3.8% at major brokerages, with the best available rates from broker channels near 3.69%. That ceiling isn't going anywhere soon. The British Columbia Real Estate Association doesn't expect fixed rates to move much at all through most of 2026. Even Mortgage Sandbox, which tracks all the major bank forecasts, says optimistic projections put the 5-year fixed at around 4.5% by year-end, with a real possibility it climbs toward 5% going into 2027. So for the person renewing a $500,000 mortgage that they originally got at 2% in 2021, they're now looking at a monthly payment that could be over $800 higher. And the Bank of Canada holding its rate means there's no cavalry coming. Bond markets have already priced in the current environment. Without a major economic shock that forces rate cuts, fixed rates are simply not going back down to where people need them to be. Canada's household debt-to-income ratio hit 174.9% nationally in Q2 2025. That means for every dollar Canadians earn, they owe $1.75. And mortgage debt makes up 74% of that. The math on these renewals is hitting people who are already stretched.
The Bank of Canada's next rate announcement is March 18th, 2026, then April 29th, then June. Most economists say don't expect movement at any of those meetings, unless something breaks, and there are a few things that could force the bank's hand. If Canada's GDP contracts 2 quarters in a row, recession talk becomes hard to ignore and the bank may cut to stimulate. Canada's Q4 2025 GDP came in flat, and some analysts are now flagging a potential recessionary quarter on the horizon. On the other side, Scotiabank's economists are watching core inflation closely. If it doesn't keep falling, a rate hike by late 2026 becomes a real conversation. 2 of Canada's biggest banks, Scotiabank and National Bank, are the outliers right now, expecting rates to end 2026 higher than they started. For homeowners renewing soon, mortgage brokers are advising people to start the conversation with lenders 120 to 180 days before their renewal date, not 30 days. The window to lock in a rate hold matters, and shopping across multiple lenders matters. A 0.20% difference on a $500,000 mortgage saves around $60 a month, and you recoup the switching costs in under a year. The June 2026 renewal peak is when the largest single wave of pandemic-era mortgages all come due at once. That's when the real stress test on the system will show up in the data. Everyone's watching that window. And that's the situation right now. The Bank of Canada made a calculated call to hold rates, and it's landing on top of a renewal wave that millions of Canadians couldn't avoid. The rate cuts that many were counting on aren't coming, at least not anytime soon. Fixed mortgage rates are parked well above where pandemic-era borrowers locked in, and the households carrying the most debt are feeling it first. Whether you're renewing this year, planning to buy, or just watching what this does to the market, this is the story that's reshaping Canadian housing right now. The market is shifting faster than anyone expected, and the next few months are going to tell us a lot about just how much pain is ahead.